What if I told you that if someone handed you $2 million today, you could build a portfolio using just two simple investments, earn around $120,000 a year, and still have a good chance of growing your wealth over time? Sounds impossible, right? Because most people believe retirement investing has to be complicated. We've been told we need dozens of funds, more bonds as we get older, expensive financial advisors, and a strategy that's almost impossible to understand. But what if that's exactly where people go wrong? What if the simplest strategy gives you one of the best chances of building and keeping your wealth? Even more surprising, a very similar approach has been recommended by one of the greatest investors in history for his own family. No stock picking, no market predictions, no constantly buying and selling, just a simple system built for the long term. And by the end of this video, you'll understand why simplicity often beats complexity when it comes to investing. But first, there's one mistake almost everyone makes when they hear a title like this. The moment people hear $2 million, they think, I don't have that kind of money. So they stop listening. But that's a huge mistake. Because this strategy isn't really about $2 million, it's about percentages. Whether you're investing $20,000, $200,000, or $2 million, the same investing principles still apply. Think about baking cookies. If you're making one tray or 100 trays, you don't change the recipe, you simply make more of it. Investing works exactly the same way. Now ask 10 different financial advisors how to invest for retirement, you'll probably hear 10 completely different answers. Some recommend mutual funds. Others recommend dividend stocks. Some build portfolios with 15 or 20 different investments. But here's the problem. More investments don't always mean better results. Sometimes they simply mean higher fees and more confusion. And that's where many investors unknowingly lose money. For decades, people have been told that the older they get, the fewer stocks they should own. It sounds reasonable. Less risk, more bonds, more safe investments. But here's the question very few people ask. What if being too conservative creates a different kind of risk? Think about retirement. If you retire in your mid-60s, your money may need to last another 20, 30, or even 35 years. That's still a very long investment journey. Now imagine most of your portfolio barely grows. Meanwhile, inflation keeps making everything more expensive. Healthcare costs continue rising. Your purchasing power slowly disappears. The biggest danger isn't always losing money during a market crash. Sometimes, the biggest danger is your money simply stopping its growth while your expenses keep increasing. That's why many financial experts now believe retirees still need meaningful exposure to long-term growth. Instead of filling your portfolio with dozens of investments, build your portfolio around one simple foundation. Keep about 90% invested in a low-cost broad market index fund. That could be an S&P 500 index fund, or a total U.S. stock market index fund. These funds own hundreds or even thousands of companies. You're not betting on one business, you're investing in the growth of the overall economy. As successful companies grow, they naturally become a bigger part of the index. And when weaker companies fall behind, they're gradually replaced. You don't have to predict the next big winner. The market does that work for you. That's one of the biggest advantages of index investing. Simple, low cost, and designed for long-term growth. But here's the important question. If 90% of your portfolio stays invested in stocks, what happens during a major market crash? Wouldn't you be forced to sell your investments when prices are at their lowest? That's exactly what we'll answer next. Because the remaining 10% of this strategy may be the most important part of the entire portfolio. So, what happens when the market suddenly crashes? It's the question that keeps many retirees awake at night. Because watching your portfolio lose hundreds of thousands of dollars isn't just stressful. It can push you into making the biggest investing mistake of all, selling at the worst possible time. History has shown that market crashes are temporary, but the losses from panic selling can become permanent. So how do you avoid that mistake? Instead of investing every dollar in stocks, keep around 10% of your portfolio in a very safe investment. Think of it as your financial emergency fund. Its job isn't to earn huge returns. Its job is to protect your lifestyle when markets become unpredictable. This could include high-yield money market funds, short-term treasury funds, or other low-risk cash equivalents. Now imagine you retire with a $2 million portfolio. If you plan to spend about $120,000 per year, that 10% cash reserve can cover roughly 2 years of living expenses. Why is that so important? Because market downturns don't last forever. During those difficult periods, you can spend from your cash reserve instead of selling your investments at depressed prices. That gives your stock portfolio time to recover. And patience has rewarded investors again and again throughout history. There's another thing that quietly reduces your wealth every single year: fees. Imagine paying an advisor just 1% annually to manage a $2 million portfolio. That may not sound like much, but it's around $20,000 every year, year after year. Now compare that to a low-cost index fund that may charge only a tiny fraction of that amount. Over 20 or 30 years, the difference can add up to hundreds of thousands of dollars. Money that could have stayed invested and continued growing for you. Remember, complexity often creates higher costs. Simplicity often creates confidence. Successful long-term investors usually focus on a few basic principles. Keep costs low. Stay diversified. Be patient. Ignore the daily market noise. And let time do the heavy lifting. Ask yourself this: if two portfolios earn exactly the same return, but one costs you $20,000 less every year, which one actually makes you wealthier? The answer is obvious. Yet many investors continue paying unnecessary fees simply because they've been told investing has to be complicated. It doesn't. Sometimes the smartest financial decision is keeping your strategy simple. If you're finding this video helpful, take a second to hit the like button, subscribe to the channel, and let me know in the comments. Would you feel comfortable investing with just 2 funds, or would that make you nervous? I'd love to hear your thoughts. Now, we've built the portfolio. 90% stays invested for long-term growth. 10% provides stability during market downturns. But one huge question still remains: how much money can you actually spend every year without running out? That's where one of retirement's biggest myths begins. Now comes the biggest question. You've worked hard for decades. You've built your retirement portfolio. But how much of it can you actually spend each year? Most people immediately say, just follow the 4% rule. It's one of the most famous rules in retirement planning. The idea is simple. In your first year of retirement, you withdraw 4% of your portfolio. Then you increase that amount each year to keep up with inflation. For many years, this has been treated as the gold standard, but here's what many people don't realize. The original research behind the 4% rule was designed to survive some of the worst market conditions in history. In other words, it was built to be extremely conservative. That doesn't mean it's wrong. It simply means every retirement is different. Some retirees may comfortably spend less. Others may be able to spend more depending on their investments, flexibility, and market conditions. The goal isn't to follow one number forever. The goal is to build a plan that can adapt over time. Let's go back to our example. You have a $2 million portfolio. About 90% is invested in a broad, low-cost stock market index fund. The remaining 10% stays in safe cash investments. Historically, a diversified stock portfolio has delivered strong long-term growth, although returns vary from year to year. The cash portion isn't there to make you rich. It's there to help you avoid selling your investments during market downturns. That's what makes this strategy so powerful. Growth when markets are strong, protection when markets become uncertain. Of course, nothing in investing is guaranteed. Some years your portfolio will grow, some years it will decline. But successful investing has never been about predicting the next crash. It's about having a plan that helps you stay invested through every market cycle, because history has shown that markets have recovered from recessions, financial crises, wars, and even global pandemics. Patient investors have consistently been rewarded over the long run. Here's something that's even more important than the numbers. Many people spend their entire lives learning how to save money. Very few learn how to enjoy it. They postpone vacations, delay lifelong dreams, keep saying, maybe next year. But retirement isn't just about protecting your money. It's about using your money to create freedom, to spend time with the people you love, to travel, to make memories. Because unlike money, time is something you can never earn back. If we simplify everything we've covered today, this strategy comes down to 5 simple ideas. First, keep most of your portfolio invested in a low-cost broad market index fund for long-term growth. Second, maintain a small cash reserve so you don't have to sell investments during market downturns. Third, keep your investing costs as low as possible because every dollar saved in fees stays invested for you. Fourth, stay flexible with your retirement spending instead of relying on a single rule forever. And finally, remember that investing isn't about having the most complicated portfolio. It's about having a simple plan you can stick with for decades. Because in investing, consistency almost always beats complexity. If you enjoyed this video and found it valuable, please hit the like button, subscribe to the channel, and turn on notifications so you don't miss future videos. And I'd love to hear from you in the comments. If someone gave you $2 million today, would you invest it differently? Or would you keep it simple with just 2 funds? Thanks for watching, and I'll see you in the next video.